Good morning, everybody. Joe here, budgetboss.ca. Often imitated, never duplicated. First things first, make sure you are liking, subscribing, and following. If you're on IG, double tap that screen. Make sure you get that heart working for me. And if you're on Facebook, make sure you share this post, like, and follow. Thousands and thousands of people do. Be a client. Make sure you're part of the movement. Let's get this going. So I want to talk about the March 1st RRSP deadline. Now that's creeping up on us. We got a very limited time where we can actually make our RRSP contribution. But the big question that people always ask me is, should I make an RRSP contribution? It can be confusing. Most people don't know whether or not they should put into an RRSP or a different investment vehicle, such as a tax-free savings account, which is why I'm constantly putting out content talking about the comparisons of the two investment vehicles. So I want people to understand exactly whether or not they should do this, and I'm going to show you how you can figure out whether or not you should be putting an RSP contribution in. So I use what is called an RSP or a tax calculator. And this tax calculator that I use with my clients, let's bring it up right now. This is from TurboTax. Now, this is a great intuitive calculator that I use to calculate my clients to make sure that they are actually doing the right thing when it comes to RSP contributions. And this year is especially important because a lot of people have received CERB money, which is the relief money from COVID, where Justin Trudeau actually sent us all $2,000, not me, but other people who lost their job due to the pandemic. And this is untaxed money. So we're getting a tax bill now, and we actually have to see whether or not making RSP contribution is part of our process moving forward to reduce that tax bill. So I use the example here of the province of Ontario, but you could choose the province that you live in. It has all the provinces and territories, and I use the example of $50,000 a year. So if you look at this post, or actually this calculator, you see that $7,200 in federal taxes owed, federal and provincial tax. So let's go down and actually put in an RSP contribution. The RSP contribution maximum for someone who makes $50,000 is 18% of their income. And that is not counting unused contribution room from the past. You have to remember that any contribution room that you could have put in the past is carrying forward. So you can technically put more in if you haven't fully maxed out your RSP every year, which most people, let's be honest, have not. But let's just go with someone who has a maxed out RSP and they're going to put in the full $9,000. So remember that we had that $7,200 in provincial and federal taxes, and we add in our $9,000, and let's calculate exactly how much tax savings there are. This shows you that the person who puts in their full contribution room will actually save about $2,200 in taxes. So you've put $9,000 to grow over time for your retirement, but you also have saved money in tax. So one thing that most people have is automatic tax deductions, and this is payroll deductions, when you get paid every 2 weeks or every month or every week, whenever you get paid or however you get paid. So you've already paid this tax. By simply putting in this money into your RSP, you will, when your taxes get adjusted, the government will owe you a refund because technically you've now made less money. Instead of $50,000 as your income on paper, your income now becomes 41,000. I'll highlight it right here. 41,462. So you've brought down your taxable income on the year from 50,000 to 41,000. That's a good thing. Now, here's the issue with it. This money that you're putting into your RSP, you have to make sure that this is money that you are not going to need in the future, or you're not going to need in the short term. This is money that you ideally will not take out until retirement. So this must be excess money. The tax savings of $2,200, albeit great, is not important to you if you need this $9,000 or whatever you put into your RSP in the near future. And that's the one caveat that people need to understand. This is not money that you're going to have to withdraw soon, because you are going to pay withholding tax when you take that money out. You are going to pay full taxes on it when you take it out. Ideally, this money gets taken out in retirement, and ideally, you're making less money in retirement than you are during your prime working years. So you're kicking the tax can down the road. That is a huge, huge factor. So I want people to fully understand what they're up against. If they do not know whether or not they're going to use this money in the next little while, whether it be any time from now, 5 years from now, in the near future, make sure that you err on the side of the tax-free savings account. Reason being is also this: if you do not put money into your RSP, that contribution room, as I mentioned, moves forward. So just because you're paying that tax bill this year doesn't mean you cannot re-up next year when you actually figure out that this money is not going to be needed for you. This is money that's going to go away for a long time, and you have to treat it that way. So if you want more tools and tips about RSP season coming up, and we got 1 week left, so the time's ticking right now. Check out my guide to the 2021 RSP season. This is our RSP contribution from the year of 2020. And if you got CERB, give me a shout, shoot me a DM. Make sure that you are actually putting money away to lessen your tax bill, because CERB money or COVID relief money was not taken off from your tax bill this year. So I just want to jump on quickly, talk a little bit about that. Make sure if you have questions, slide in my DMs, shoot me an email at joe@budgetboss.ca, or you can even book a meeting at budgetboss.ca/contact. One thing I also want to leave you with is that if you have an RSP and it has not grown, make sure that you are adjusting your asset allocation. Make sure you're adjusting the funds that you're in so you can get some growth out of it, because this is money you're not touching for a long period of time, more than likely, and you want it to grow. You want this account to actually be working for you instead of against you. And there's so many dormant RSP accounts that are set up at the bank that are just not doing anything for the clients themselves. I want to help people actually put them into dynamic funds that grow over time, instead of just sit there stagnant and getting 3 to 5% returns when it could be anywhere from 8 to 15 to 20% returns given the year. We do not know, but the one thing we do know is that 3% returns every year, not really doing it for you. You need to get better than that. The market itself does much better than that. So make sure you're actually taking a look at that. Pull out your annual statement that came at the end of January, beginning of February. See exactly what happened last year. And if you're confused about it, shoot me a message. So that is my post for today. If you have questions, jump on. Make sure you are liking, subscribing, and sharing, and make sure that you are part of the movement moving forward. Lots of great content coming out, and I want to make sure that everyone is getting some value for it. So thank you for joining in. Peace.